And David, I think of you as more or less a value investor. So it tells me something if you're sniffing around here. What names do you like?
So some of the large cap tech has gotten hit along with the overall group. So things that we like right now would be Facebook, Google, Microsoft. We think all are very good businesses. They've been richly priced, and now they're selling at pretty reasonable prices. The Facebook and the Google are about 20 to 22 times earnings. So relative to the group, very attractive. We think they've been thrown out with the bathwater. We think when tech rebounds, they're going to be one of the first to rebound, and you're getting them at a great price.
Basically, you're sticking with Megacap tech. I don't see Netflix on that list, though.
You don't. Rather than Netflix, we like Comcast or Viacom, which are selling at much better valuations. We're still very wary about companies that are at 40 to 100 times earnings. We think there's a lot of air in those stocks. There's a lot of air that can come out. The reason that we picked the three that we identified is they've had the stocks sell off, yet their prospects are really good, and the valuations are much better than the overall group.
Yeah, Comcast, our parent company, of course, there are shares of Viacom CBS under some pressure today. So anywhere else in tech where we've seen some stocks with declines of 40 to 80%, depending on where you're looking? A lot of those are smaller names, some of them still high multiples. Is that anything else that interests you?
Not so much. We think that you want to have a barbell approaches here. So you can buy some of these big tech stocks at a dip, and then we'd spend most of your money or put most of your money in the value area of the market, dividend stocked area of the market. We think that's going to be the best way to navigate 2022. We expect a lot of volatility. You've had 4 pullbacks of 2 to 5% since August. We think you're going to see more of the same as the year progresses. And the best way to make money this year is to buy really good businesses under 18 times earnings. There are lots of opportunities like that. We think you're going to have an average return for the market this year, like 8, 9, 10%. And we think those are the stocks that are most likely to succeed.
Any examples off the top of your head of stocks under 18 times?
Sure. eBay, Medtronic, Unilever are all good companies, good prospects. We also wouldn't buy the banks in front of the earnings season, but we would buy them after they report if they dip. So we like JP Morgan. They had a good earnings report today, but a pretty cautious and negative outlook. As a result, the stock is sold off a lot. We think once the dust settles, that will start to do better as the year progresses. We do think there are lots of opportunities in banks, but if you look at the last 6 quarters, banks have reported good earnings and sold off the day and the week of those earnings reports. Then they do better throughout the quarter. We think the same thing is going to happen this quarter. So we would not be buying the banks in front of earnings, but we do like them, and we would buy a dip.
Shepard Smith here. Thanks for watching CNBC on YouTube.